Professor, I have one actually. Sorry.
Yeah, no, don't be sorry. Please,
So,
questions are good.
you pointed out that on the machine platform, it's listed as a necessary machine platform, and that's how you know that it's part of the acquisition cost.
No,
So, say you're like doing an account for some company or whatever, and they don't specify whether these things are needed or not. So, how do you know whether to put that in acquisition cost?
no, so that's a great question, Christina, and that's what makes accounting interesting. We have to go determine it, right? We have to do research. So if they don't know, then we call the supplier, and we ask the supplier, hey, can this operate without the machine platform? And then the supplier might say, yeah, you can, or oh no, you need this. It's an essential part of the machine. And then we would get some kind of written evidence to substantiate that fact.
Okay, thank you.
Does that make sense?
Yes.
Cool. Great question. Great good question. So we'll talk about depreciation now. So we talked about, right, we're just talking about those three buckets. Acquisition, we've covered it. Next two buckets, what's the depreciation when we use the asset, and then what's our disposal. That's all we're covering today. We're just going to go into those details now as you become more advanced accountants. So depreciation is the process of allocating the costs to the accounting period where they're benefiting from its use. What does this remind you of? This is just the matching principle, right? We've talked about this 100,000 times. You're probably sick of me talking about it, but you need to get that we always have to associate the costs with the periods of benefit or use. Because that's what accrual accounting is. So balance sheet, our acquisition cost is unused, and then as we allocate the cost, it hits our income statement, right? So if we buy a $100 million building today that's lasting us 30 years, we're not going to have a $100 million expense this year. That $100 million will be smoothed out over the next 30 years. We'll have an asset on our books, right? Rather than if we just spent the money on a non-building or rent, it might be different. So factors in computing depreciation, we need to know the cost of the asset, which is why the acquisition cost is important. The salvage value, which is the disposal cost, this cost we expect upon disposal, and then the useful life. So how long do we determine the asset to be used for? And so we've gone over the cost. We'll go over the salvage value and useful life. There's many different types of depreciation methods we can elect as well. Remember how we elected FIFO, LIFO, or weighted average for inventory? Again, we have similar options for depreciation. Straight line, units of production, and declining balance. And then there's something called double declining balance and 1.5 times declining balance. Isn't a comprehensive list. It's just a list of elections. So for accounting policy, a company will choose a type of depreciation method depending on the asset class. So you might have different depreciation methods for different assets. A building might use straight line, while laptops might use declining balance, but most companies just elect one policy and then apply it to all of their assets. We'll go over the difference of all of these, but we require these inputs for most of these different depreciation methodologies. And then so the company would just choose one of these, and then they would go from there. There's advantages and disadvantages to each of these as well from a business perspective, which is, as an accountant, that's where you can add value, is helping determine these elections. So assets we would depreciate in future screens. You're going to take the cost of something, the salvage value, and then the difference is your depreciable cost. So let's say we bought a $10,000 car. We figure at the end of its life, we can sell it for scrap parts of $1,000. We're only going to depreciate $9,000 of cost. And then we're going to depreciate it based off of one of these methodologies. We either do it based off years or based off of production, if it's a machine. If it's a car, you could also do it based off mileage, right? We can choose our estimate. The straight line method is the easiest. And so I'll put these side to side so we can do some of these. Straight line method. Straight line method is the easiest, where, let's open that up a little bit. I'll show you how these all can be different. Depreciation. So the fact set, there's a cost, salvage value, depreciable cost, useful life. $10,000, 1,000. The difference is the depreciable cost. The useful life is 5. The units inspected of this machine, 36,000. So this machine can also inspect 36,000 shoes. So the straight line methodology, we would take the $9,000 of depreciable cost and divide it by the 5 in order to get our yearly depreciation expense. And then our journal entry would be debit depreciation expense of this 1,800 and credit accumulated depreciation of 1,800. The depreciation expense is an expense account. It reduces income. The accumulated depreciation is a contra asset. And so it reduces the asset value. So our machine at the end of year 1 would have a $10,000 gross value minus our 1,800. It would have an $8,200 value, net value at the end of year 1. They'd be netted against each other. So on the financial statement, you'd see gross value year 1 of 10,000 less accumulated depreciation of 1,800 equals net value of assets, which is our $8,200. So that's the straight line method, right? Did we get how we get there? We had to get to our depreciable cost, and then we had to divide the depreciable cost by the useful life. And then we'll recognize that evenly. If it's a half year, then we prorate it by the year, right? We'll do it by the number of months at the end of the day. See, the straight line method gives us kind of a clean accounting where if we bought it at the beginning of the year, every year we'd recognize $1,800 of expense, and our asset value, our net asset value would go down by $1,800 until we hit the end of its useful life, where it would then be worth $1,000. And that's that. Then we'd either sell it or dispose of it, or we might keep it, and then we might have to revise estimates. We're going to that. And this is what it would look like, right? Every year, the schedules are important. We'd have our period. The depreciable cost never changes from when we determine it. The depreciation rate is always going to be 20%. How did we get 20%? Well, you just take 1 divided by 5, right? 1 divided by 5. That's our depreciation. Rate straight line. Accumulated depreciation increases by 1,800 every year, and the book value decreases by 1,800. Relatively simple. Does that make sense? Cool. So how's that different from units of production? Units of production, we no longer take straight line. Straight line's the easiest method. Instead, we're going to take the units of production, which is going to say, what we're ultimately trying to do here, to take a step back, is how do we match it to the system that's most relevant? And so we'd ask ourselves as a business, what drives our business? Are we expecting like the life of the asset to be relatively even? Then we use straight line methodology. But if we think that the life of the asset is really dependent and the value it adds is dependent on its units of production, we'd use the units of production method. Or we then take the units inspected and determine a cost per unit. And so we have here the cost minus the salvage value is still going to be the 9,000, the depreciation value. But we know that the machine has an expected usability of about 36,000 units. So it's about 25 cents a unit of cost that's associated to each unit. This is separate from the straight line method. It'd be a different election. And then every year we'd have to determine how many units we used and then allocate the units of production method. So let's say year 1, we sold 7,000 units, or we produced 7,000. You'd ultimately allocate depreciation, $1,750 of depreciation expense. And the journal entries wouldn't change. Journal entries then would be debit depreciation expense, $1,750, accumulated depreciation, $1,750, and then your gross value wouldn't change. Your accumulated depreciation of $1,750, so your net value would increase $50. And so this is what the schedule would look like after all your journal entries. So you can see that depending on the number of units sold or the number of units produced, our dollar value of depreciation expense would change. So for your quizzes, if I ask you to do this, you'll have to be able to determine the allocable value based on the depreciation per unit and then allocate it to the periods. And I can ask you for any one of these periods. Where students really get messed up a lot with this is they accidentally take the gross cost instead of the depreciable cost. So make sure you don't mess that up, right? Make sure you know that the depreciable cost is what we use. You have to subtract out the salvage value, not the gross cost, the 10,000. And then if you have to determine the book value, then you use the 10,000, right? So just make sure you understand the difference of those two. And then here's where we get complex. So we can kind of get like units of production is based off the units of production. That's simple. Straight line is based off straight line. Well, some assets like technology, we say they lose a lot more value in their first year, right? Like the first year they're brand new. First year you get an iPhone, it's brand new, it's worth $1,000. The next year it drops in value a lot because a new iPhone comes out. Same thing with laptops or other technology, maybe cameras. So double declining, we might use more for these types of technology businesses. We'll use the same inputs, except for double declining, we base it off the rate. So the rate, if you remember here, we take the rate of the depreciation single straight line. The straight line rate is 20% because of the 1 divided by the 5 years, and we double it. So our rate now is 40%. Then we take that 40% and we multiply it by the gross cost, which was 10,000. Where is it here? 10,000. So our first year of depreciation is actually 4,000. So we're accelerating the depreciation a lot more with this methodology. The difference here is we use gross costs, net of salvage value. Right? So some methodologies use the net of salvage value, some don't. This double declining balance method, you determine the percentage not using the salvage value, but then it comes in, you use percentage. But we still can't depreciate below our salvage value. So we can see here how the schedule works out. The schedule works out, we start with 10,000, then our first year we'll have a depreciation expense of 4,000. And then we'll have 6,000 net value because the 10,000 minus the 4,000. That 6,000 then will be multiplied by 40%. So, or we can call it gross cost book value. So then the next year, book value year 2 is at 10,000 minus the 4,000. We take that 40% times the new book value of 6,000. Depreciation year 2, and gives us our new book value, and so on. So you can see that the depreciation expense starts really high and quickly declines. That's why it's called the double declining method. So it's 4,000, then 2,400, then 1,440. And then in the last period, what adds complexity is we can never get below the salvage value. And so if we get below the salvage value, we have to do a difference. And so here, since we only have $1,296 in year 4, only 296 is depreciable, even if our calculation just says it's more. And so you can see here how choosing a different depreciation method can give us very different results from a timing perspective for assets. So if I'm a business, I need to be careful in choosing which kind of depreciation method I choose, because it also affects my tax reporting. So the idea here, right, if I'm a business and I choose straight line, I'll have a pretty even impact on my financial statements. If I choose units of production, it'll be based off the production, the usability. If I have double declining, I'll accelerate a lot of that depreciation, which means I might get a tax advantage in the current period, but it also means that I'm going to take a financial hit in the current period as well, right? And so what we're saying here is that most corporations use an accelerated depreciation for tax reporting. And so just know the tax reporting and the financial reporting might be slightly different, but it makes sense that most of us don't want to pay taxes today. So they're going to choose a methodology similar to the double declining method for tax reporting. But then for financial reporting, most choose straight line for ease of reporting. So there's a lot there. So I'm going to let the class kind of take a break and sit on it and try to work through some of those problems for about maybe until about 9:50. And then we'll go into the next piece for explaining partial years. And we'll come back when we come back. Ask me some questions if you're confused on any of this. Work through the Google Sheets that I have up here. Make sure you understand it, so we can go over questions. But we'll upload this lecture, and I have other lectures where I go through more practice problems on this. But I'm happy to continue to go over it. I know this can be complex, so I really need you for your midterm. You need to know straight line method, units of production, double declining, lump sum allocation, and acquisition cost accounting. You need to understand all of that. So spend a few minutes, and then at 9:50, we'll come back to class. Thank you. So now, since we got the gist of the different depreciation methods, let's talk about what we do for partial years and changes of estimates. So all these are estimates at the end of the day, right? Let's not get confused. Saying that a computer is going to last for 5 years doesn't mean it's necessarily going to last for 5 years. It might go quicker. It might go longer. And ultimately, we're going to have to revise our estimates yearly. And so also, we don't just buy assets at the beginning of the year. You might start your business in the middle of the year. You might have to buy a new computer 3 months into the year, so on and so forth. So we have to account for partial year depreciation. Partial year depreciation isn't too complex. Instead of doing it for the whole year, you just allocate it by the months. I'm not going to ask you for days, just do months. So if we buy it in October, we assume that November, since it's the beginning of October, we'll just assume we do it for 3 months, October, November, December. So the month that we buy it in is the month of depreciation. And so we take that original, what we have here, where is it? Where's my Google Sheet? Here. And instead of it being 1,800, we just divide this by 3, times it by 12. Oops. Divide by 12 times by 3. We get our $450. That 450 is our depreciation, and we continue to do prorated, right? So the first year is going to be a different depreciation expense. The last year is going to be 9 out of 12 months, and the rest will be a full year. So you can do that for anything. Not too complex. A little bit of complexity is what happens if our estimates change. So what if our useful life estimate or our predicted salvage value estimate changes? So let's say we bought a laptop. We thought we're going to change them out every 5 years. Turns out they're awesome, and it's going to take 10 years. And so what if we have to revise their value? We just, at the day of our revision of estimate, we take the book value less the revised salvage value, and less revised, we just redo the calculation on the revision date. And then we continue to move forward with the calculation. So that's it. It sounds complicated, but you just, at the point of the modification, at the point of change, that's when you redo the calculation that you already know. I'm not going to spend a lot of time on testing you on changes of estimates. I will test you on the partial year because you have to understand allocations and how do yearly allocations work. And we've worked on that a bit already with inventory. So I don't think this will be too hard. The changes in estimates, that's a huge part of accounting, but it's not something I think that I need to focus on for this class. So just be aware that when an estimate changes, you need to redo the calculation, but I'm likely not going to focus on this in your examinations. There might be a homework assignment. And then this is a reporting. So let's go over some questions real quick. This is more similar to what you'll get on your homework quizzes and whatnot. So let's say there's a machine that costs $22,000 with a 5-year estimated useful life and $2,000 salvage value. So we can just copy all this again, right? So we just copy this down, copy paste it. Boom. So you can just go cost is 22. 1, 2, 3, $2,000 salvage value. The calculations will automatically calculate it. And 5-year useful life. And we know it's going to produce 1,000 units of production over its life. 1,000. And we're asking, can you determine the depreciation expense for each period? So straight line, if it's at the beginning of the year, it's just $4,000 a year. Right, easy. How do we get the $4,000 a year? So 22,000 minus 2,000 equals our depreciable cost of 20,000 divided by 5 is our 4,000. Units of production method, we're going to be doing $20 per unit. So 22,000, we get the 20,000 depreciable cost divided by 1,000 units. And so if our year one production we get here is 200, then we have $4,000 of depreciation. And so you just take this 20 times all of the different years and you'll get your depreciation expense for that year. Double declining is a little different. And that's what this is, the unit depreciation here. Double declining, right? We're going to have to take the straight line rate of 20%. We double it and then multiply it by the gross cost on year one. And so we get an 8,800 depreciation expense year one. And then we subtract that to get our book value, and then our book value times the 40% to get our year two depreciation, and so on and so forth. So you'll need to know for your homework and quizzes and all how to do the depreciation expense using all these different methodologies. I don't want you to focus on this need to know 8.2. Don't worry about that. I really just want you to come away from this class understanding the three different methodologies. Does this make sense? Any questions?